Hi, I've just been told questions are coming up, so I'll do a very quick introduction to myself. My name's Ben Stiles. I look after financial services at Xero. I joined Xero about 3 years ago, and the whole reason I joined Xero was because of what we're talking about today, which is using really well-structured and secure information, and we all call that data, to actually make better decisions. So hopefully we can help you with a bit more insight into what we're doing there. So I'll pass this on to Amy.
My name's Jack. I founded a company, CrowdfundUP. We do alternative finance for commercial property. I'm also a director of FinTech Australia. Had the benefit of travelling to other jurisdictions around the world and seeing, the ongoing discussion around open data and sort of how that can add a lot of weight to a healthy environment, financial service sector, and hopefully we'll be seeing that in the Australian jurisdiction in the coming 12 months.
My name is Adam Flesch. I'm a principal at Oliver Wyman Australia. Oliver Wyman is a leading global management consulting firm, and we focus a lot on financial services and industry. We have a strong presence in Europe and in the US, and growing fast in this region. And obviously open data, open banking is a hot topic in Europe these days. We serve many of the banks over there. Some of them Shane mentioned in his visit. And it's an exciting game changer potential for the industry. And I think here in Australia, this is a timely topic to discuss because it can be a tipping point on which path the Australian market will go. And it's not only about banking, it's broader. It's about cross-industry or above-industry potential. So I'm excited also as an individual to see how a new area will be in terms of how I'm going to be serviced as a customer.
I'm David Grafton. As you can see from the slide there, I'm not currently associated with any particular company, so today I'm having a break from having a break, which is a little bit different. Previously, I've spent about 10 years working for credit bureaus, both in the UK, the US, and obviously in Australia and New Zealand. So I've been a passionate proponent of data sharing. I founded the industry organisation that's pushing for comprehensive credit reporting. And in between working for credit bureaus, I also spent 7 years as the Chief Risk Officer for Commonwealth Bank, for the retail bank. And in that role as well, I could see massive, massive benefits from a wider access to what we're now calling open data. Not just for making a credit decision, a credit risk decision, but increasingly being able to answer the question about whether somebody can afford to repay the loan. So we're seeing a lot more activity now around servicing, and an opportunity to automate that, I think, is one that we should take.
I'm Amy Ciolek. I'm a lawyer with Ashurst, and I'm going to be facilitating today's panel. So just to set the scene, data collection, disclosure, use and storage is really fundamental to financial services businesses, and it really does change what you can do and how quickly you can do it, which is pretty important at the moment, because more so than ever, your clients are probably expecting very fast results, and they probably don't want to be frustrated by having to go and collect manual bits of paper to verify or to prove their financial position. And you're probably also finding that you've got access to third-party systems which you're able to integrate with your own systems. So all of these things are great. However, you're still fairly constrained by the current Privacy Act. It's hard to believe that the Privacy Act has undergone a major transformation, and we're now dealing with the new Privacy Act, which became live in March in 2014. The reason why it might seem like the Privacy Act doesn't necessarily reflect the way in which we expect business to be done these days is because for law to go live in 2014, it's probably undergone 2 years of debate with Parliament, which takes you back to 2012. And then there's probably been another couple of years of drafting and consultation, which takes you back to 2010. And then the modelling was probably based on research that was done between 2007 to 2010. Now, to put things in perspective, I had a look on the ACMA website, the Australian Communications and Media Authority, and back in 2010, only 17% of Australians over 18 used their phone for banking. And that was partially due to trust. And then only 9% of Australians use their mobile phone for shopping. Now, if you contrast that with today's day and age and how frequently we use our mobile phone for pretty much everything, that's a massive difference. So our mobile phones today are practically like our remote controls to our life. And if I can't do something on my mobile phone, I probably don't want to do it. So our government realises that there's a bit of an issue, and the Productivity Commission is currently looking into this. But it seems like this is a massive issue, and it's really hard to know what the real problems are and who should be the ones to fix it and how. So we heard from Shane Elliott earlier, who mentioned open APIs. So over in Europe, you've got the legislature pushing for banks to open up their data to other participants. But in the Productivity Commission's report, it seems as though there's a focus not on the individual owning their personal information, but a shared ownership. So it will be really interesting to see how this all pans out at the end of this month when the report is released. So that's just to set the scene. And we've got 4 really intelligent guys here who have had a lot of experience in this area and all come from a different background. And so we're going to move across to the questions, and hopefully you can get a feel for how they're dealing with this sort of issue from their perspective and why it's so important. We might start with Jack. Now, Jack, how important is open data to fintechs, and how could this in fact help banks?
Well, open data for fintechs is, moving forward a really critical pillar of the wider ecosystem. What open data allows is a variety of different verticals to be chipped away at an incumbent. You could be decision making, it could be around personal lending, it could be around car finance, but really what banks have is, I think Shane said it before, they're the custodians of these data. If I've got my money in a custodian account, I want to be able to direct it somewhere. Now, what a data set will allow me to do is to be able to leverage, my financial history, my financial path, so to speak, to get better decisions made for my personal circumstances. And what a fintech is able to do is to go and look at, one segment of a data set and say, okay, well, if A, B, and C checks out, then we'll make this decision in a certain way. Now, why that's really interesting is because what it allows is a vibrant ecosystem to sort of flourish and uproots to pop up out of the ground, and really get this roundabout way of where a fintech startup can then be an outsourced R&D component of a traditional institution. They've been able to use this data in an innovative way in a small team, and to be able to go, okay, well, we think we could apply the data in this certain segment to make this decision, something that a team of 16, 20 or 30 at a bank hadn't thought of. It's that really quick, nimble thought process is sort of outsourcing the R&D. So really open data is about competition. I think Shane said it before, a vibrant competitive landscape is great for our financial services industry, whether it's a tech startup, whether it's a bank, competition is good. And really, market forces demand that, R&D will be done by a startup, and if that startup is really that good, then someone with a big balance sheet will most likely go in and buy it if someone's willing to sell it.
So in my past life, I worked in the IT sector, and we worked out that it would have cost us about $800,000 to collect an additional piece of data. So as you can imagine, if banks were required to provide their data or provision their data in an open way, it could become extremely expensive. So David, do you think that it's the bank's responsibility to carry this cost? And do you think it's fair to impose such an obligation?
You're making it sound like something that's one-way traffic and very onerous. There's a flip side to all of this, which has been borne out many, many times over by research work that's been done in this country and overseas, that shows that for a bank to be able to use comprehensive credit reporting information, you make significantly better credit decisions, and that dramatically reduces your bad debts and also enables you to open up new markets for credit where currently you haven't got enough information to say yes to somebody that's applying to you. So there are very significant dollar benefits to banks that arise from an increased size of the market, and also, depending on where the bank's risk appetite is, a reduction in bad debts. And so while it's true that the infrastructure costs that have been spent to date and continue to be spent in the banks that are getting ready for comprehensive credit reporting, in my estimation, we're looking at hundreds of millions of dollars, not tens of millions. This is a huge, huge cost. Those costs have been largely incurred, so a number of the banks will be ready to go. Whether they do go or not is a whole different question that revolves around kind of game theory and some of the issues around losing your crown jewels. But there is no doubt at all that if you look at the financial benefit that banks get from taking part in comprehensive credit reporting, it is massively positive. So it's good for banks. It happens to be good for consumers because you're making more responsible lending decisions. And it's also good for the economy because it widens the credit market.
Adam, what's your view on whether or not open data is a threat or an opportunity?
First of all, I think it depends on the level of radicality of how the regulation will evolve here. In Europe has taken a quite aggressive and progressive approach with the general data protection regulation that basically sets even above the industry a certain rules that basically have major implications for the industry and how they need to open up their data and how they need to comply with certain regulations. I think for the industry, I see short-term a lot of pain, potential pain, mid-term potential threats, and basically mid and long-term a lot of opportunities. Maybe let's just focus on a little bit on the threat, which is more strategic. If you think about banking, the banking value chain today, it's pretty much controlled by the incumbents, from the customer relationship, front services, sales process, down to the balance sheet provision and technology behind that. Now, what do you need for any market player to attack this value chain? You need basically three things. One is capability for that particular value chain element that you want to be part of, be the best of. And this is there are capabilities outside existing. I think this room has already showing these capabilities. Secondly, you need scale, and Shane also mentioned this. This is a more difficult thing. How you can create scale to run it efficiently, every element of the value chain. But the most important is you can create and attack the banks only if there is data access. And basically this open data approach that the customer has the permission, basically takes control, ownership of its own data, will open up the opportunity for anyone to play a part in this value chain. And this is kind of, I don't think it's a short term, it's more a mid and long term potential threat. But this is a great opportunity because for the banks, because to be successful, you need to basically have the trust of the customer, because the ultimate winner will be whoever will be able to influence the customer to say, give me your consent for your data so that I can bring you the best of best, what is available for you. And today, if you think about who would you give your trust, or where would you place this role in the economy or in the marketplace? Would you trust a no-name fintech startup? Would you trust the government, or would you trust your bank? And most likely, customers still today think that the banks is the best custodian of their data. So it's a big opportunity because whoever is controlling that part of the value chain controls the entire value chain.
Thanks. David, now you mentioned earlier that the major banks were already preparing themselves for sharing comprehensive credit reporting data. Do you think that it should stop there, or do you think that the data set should be broader than comprehensive credit reporting?
I think if you look at the Productivity Commission report, which I have to say I was very encouraged by, there's a much broader picture emerging here, and that points to encouraging wider data access, which goes way, way beyond comprehensive credit reporting. One likely early cab off the rank is going to be a move towards encouraging banks to be able to share information that they have on a customer about that customer's statement. And that means that you can very easily then understand the customer's financial position, you can understand their income, you can understand their expenditure. And currently, we're back in the dark ages where you have to turn up to a branch with a pay slip or a physical piece of paper. And that's a terrible experience for the customer. The drop-off rates are huge, so there's an incentive again for the banks to automate this process. And if you look even further than the financial sector, there are very clear benefits that are to be obtained from the wider sharing of data in the public sector and between the public sector and the private sector. So I think what the Productivity Commission has opened up is an absolutely fascinating area that's going to keep all of us hopefully very busy for a long period of time with very clear consumer benefits as outcomes.
Thanks. Ben, we haven't heard from you yet. So there's been a big focus in the Productivity Commission's paper about efficiency and opening data for efficiency, and then there's a big focus on fintechs receiving open data to enable them to be innovative and so forth. Is this all about the fintechs and efficiency, or does this have another sort of perspective and another view?
Well, first of all, for those of you who don't know Xero, we're actually not a fintech. So we're coming from a slightly different point of view. The second really interesting point there is that a lot of the things that we're talking about today, we've actually been doing for about 10 years. And what we found is, to David's point, there's an awful lot of efficiency that can be gained in the ecosystem, in the financial services ecosystem, by sharing a limited set, secure set, and a controlled set of customer information and giving them control about that. And really what we found is that although there are a lot of efficiencies to be gained, there are also some points we need to be really careful of. The first of those is we've been quite mindful around customer control. And the very first thing that we decided when we started opening Xero, and by opening Xero, we actually started sharing data out of Xero about the same time that we started receiving data into Xero. So the way we work is we work with banks. They provide transactional data into Xero so that a small business can automate their processes. And then we give that small business the ability to actually share their data to other software providers, to other financial services providers to help make decisions or to automate their software or the way that they do business. And that whole concept of giving the customer control over what they share and to who is actually at the core of everything that we do in this space. And what that's allowed us to do is actually learn very quickly, but also very safely, because what we haven't done is actually exposed what everyone thinks about when they think about an open API. A lot of people think about, wow, there's this big pipeline of data that third parties can go and suck and make a whole bunch of insightful information from. In fact, what we do is we found that giving the customer control and sometimes at a granular level in terms of, do I want to share my transactional data or do I just want to share information about the invoices that I've raised? Giving them that kind of control is really important. The second is that I think regulation is actually going to prove to be more of a challenge when it's introduced, and it does feel like it's a when than prior to it being introduced, and that's because there isn't a lot of very good conversation at the moment in the public domain. It's very much so in the private domain, David, so I'm aware of that, around what kind of data do we actually want to be shared. So David talked about transactional data before. Absolutely, I think small businesses, consumers, big businesses can all see the value in sharing transactional data. The question's actually going to be, but what other kind of data am I comfortable sharing as a consumer, as a small business? Do I want the insights that an institution has formed about me, whether they think I've got high propensity to have another kid next year? Am I likely to buy a car? Do I want that kind of information shared? And it's quite interesting that the debate in the public domain doesn't actually define that very well. So I think there are some quite interesting boundaries that are going to be explored here. Giving customers control, we found, is what's going to enable a really good conversation.
I'd add security to that, because once you've got an open API and the customer then says, okay, well, I want control over this, and they've given consent, that's fine, but it's only fine if you've got the right security controls, which will guarantee that the information that the consumers are given consent to is only the information that's going to be passed on and used in defined circumstances. And I think that's a really big challenge as well. There's a whole security question that wraps around that.
Absolutely, and I think that actually comes to the heart of the challenge. So I was reading somewhere that there was a statement around the big banks being forced, and I will use that word. It sounded like forced to provide open APIs by 2018. The investment that's required to do that securely, so we've been on that journey for 10 years, is significant. And no financial institution is going to step into a situation where they're sharing that kind of information without a high level of security.
Maybe I would add to this. I see two things related to this. One, in terms of the expenses, investments, the costs of doing that. I think a bunch of the investment and development required by the regulation, let's say in Europe and most likely here, will be absolutely in line with what the banks should, by the way, do themselves in order to be more customer-centric and superior in terms of service. So I think a lot of this investment should anyway, so I see it's more like a speeding up of these investments, creating a better data management platform within their banks, kind of using the APIs also internally to have better insights of their customers and kind of predictive analysis of their needs and the risk profiles. The other aspect is, which was also a little bit, I think, in Europe, which led to some of the proactive approach of the banks while they formulated this open banking working group 1 or 2 years ago, was the realization that even today they are already exposed to the risks that you mentioned. In terms of the screen scraping already provides basically some of the functionalities of the future of open banking to some extent, but this is an absolutely uncontrolled, unsecure way. And basically, if anything goes wrong, then it's the bank's reputation at risk. So the banks realized we're better off controlling this game, creating standards around this, so that we have a closed loop, and we kind of set the scene, the quality, the standards for who can be part of this, and ensure a system in which there's redress if there's anything go wrong, there's a metadata capturing so that we know where it was and we can prove who was not complying with the rules. And that, I think, is a great kind of benefit and opportunity for the banking system, but for the entire marketplace.
I think you raise a really good point there around the customer experiences that the bank should be providing anyway. And when we stepped back 3 years and we were actually thinking about this. So how do we actually work more closely with financial institutions so that not only will they share more data, but they would actually be able to provide access to that data in a more seamless way. And all I mean by that is make it easy for me to set up a bank feed into my Xero subscription. And in doing that, we actually arrived at, and David, you were talking about this for quite a number of years beforehand, around this concept of reciprocal data share. And really how we found that to work very well is where a financial institution shares transactional data into a Xero subscription. That same financial institution is then able to request access from that customer for access to their Xero data. And what that means, if you think about it in the most practical terms, if a bank needs to be able to lend to a Xero business, a business that runs itself on Xero, that they can actually access that data and make a lending decision. And so what it becomes is, instead of a one-way transaction, it becomes a two-way transaction. And it's one that, at the centre of it, the small businesses has actually been in full control. The small business has authenticated and chosen to share their data into their subscription. They have then chosen, on the bank's request around a specific product, to share that data back and get a lending application filled out and approved on the same day. And we're already doing that with big four banks in the Australian market. NAB have moved incredibly fast and built some highly innovative product, and they're iterating on that. They're moving very, very fast. And we think that it's those examples you've described around customer experience and making sure that you've got really tight security around that and understanding where the data is will mean that these kind of innovations will become the norm.
Well, that's really interesting, and a few of you have touched on this in your discussion. So around the ownership of personal information, it seems as though you're implying that the individuals or the businesses should have ownership of their own information and should dictate how that's dealt with. Would you generally agree or disagree?
Well, up to a point, it becomes a very tricky area very quickly, actually, because if you talk about the data trail that you or I might leave behind in terms of transactions, or on a credit bureau, who have you applied to credit for? Have you defaulted, yes or no? Then that sort of information at its most granular level, I think there's a case for saying, yes, that's the consumer's, that's my data, I've actually done that. But of course, it doesn't stop there. So in the case of a credit bureau, it's very common that the data that you've left behind as your data trail is then used to calculate value add credit scores, and that's intellectual property, which you would argue, I think, should belong to the company that's actually produced that credit score or has innovated on that algorithm. So it's not an easy yes or no answer to you. It's an it depends answer.
All right, well, on that point, we'll have to leave it there because we're getting in the way of you and your lunch, and that's not a good place to be. So thank you very much to the panellists, and thank you very much for listening. And yeah, enjoy your lunch. Thanks.